If you don't know me, my name is Krish. I'm 17. I dropped out of school 8 months ago with zero in my fucking bank. And now I have over 2 mil in funding and make over 5 figures a month using this exact concept, which is more important than any ICT concept I've ever learned. Entry systems, amazing, but draw on liquidity is the number one thing you need to learn. I'll be going through this in more depth. Remember, draw on liquidity is more important than bias, because a lot of the time, your bias for the 1 hour can be bullish, but for the 15 minute, you know you can catch a 15 minute expansion to the downside, right? But that's based on draws on liquidity. So first I'd like to go through why does market move and how does market move? Well, you should already know that market moves in ranges, consolidation, or trends, expansions, or distribution. And for a trend to happen, we have to have AMD, right? AMD, market moves in AMD. But smart money moves the market. Now, what is smart money? Smart money refers to large institutions like they call them market makers, like hedge funds and banks, which fill their orders at sell side and buy side liquidity before funding the expansion. The expansion happens because smart money takes out liquidity of the retail traders going long with their resting buy orders and sell orders at highs and lows, right? Before every expansion, some form of liquidity has to be taken out. You can think of liquidity as fuel. And so market chases highs and lows, resting liquidity, to fill their orders, take out this high, take out the liquidity to fuel the expansion to the downside, right? So every expansion happens because some form of liquidity, buy side or sell side, is being taken out, right? Because liquidity is fuel. To move the market, market needs to take out some form of liquidity. But in terms of understanding how and where the market is moving, you need to understand institutional order flow. You need to ask yourself, are we in a buy program or are we in a sell program? And what that means is, what PD arrays are we respecting? Are we respecting bullish PD arrays and disrespecting bearish PD arrays? Or are we respecting bearish PD arrays? Well, you can see here, we're clearly bullish. We start to break past this high, and this is the 1 hour chart. We start consolidating. We manipulate into bullish PD arrays. We respect this bullish PD array, this bullish fair value gap, and start disrespecting all the bearish PD arrays within this leg here, right? Whether it be bearish PD arrays, we're inversing them, bearish order blocks. So we're respecting bullish PD arrays, we're disrespecting bearish PD arrays, and in terms of highs and lows, we are turtle swooping lows, sweeping lows, and breaking through highs, right? Same with in bearish scenarios, right? We turtle swoop highs, we break through, inverse these bullish PD arrays, and we're respecting these bearish PD arrays, like this bearish fair value gap, for example. See this bullish PD array, this bullish fair value gap, and disrespecting it by cutting through it, and then we can see we're displacing past and using this bearish fair value gap as support to go down, right? What PD arrays are being respected and what PD arrays are being disrespected. That is institutional order flow. You can't just look at a random fair value gap like this, for example, and without bias or any order flow, you'll just look at this bullish fair value gap, and then you'll be like, oh, we tapped into it, let's go long here. Let's say you're taking a swing trade. Oh, let's go long, change in state of delivery, and then you get fucking stopped out. Because the bias was in completely opposite direction, our order flow now flipped from a bullish buy program to a sell program. This is a clear market maker sell model, right? You need to understand that. Next thing is, how do we know if it's going to be a retracement or a reversal? Well, let me go through another example here. So as you can see, we were clearly bullish, right? Before every expansion, turtle swoop expansion, right? Turtle swoop expansion. Comes down into some form of 15-minute sell side. If I go on the 15-minute, turtle swoop expansion. Before every expansion, it needs the liquidity which acts as fuel to fund the expansion. Every expansion has a turtle swoop. Before every single expansion, there is a turtle swoop of some sort. That means there's some liquidity being taken out. So we know the market moves by taking out highs and lows for us to fund an expansion. So if we want to trade expansions, we have to trade after turtle swoops, right? Because that's when the liquidity is being taken out for smart money to fill their orders and move the market. So take this for example, right? We were bullish and then we total swooped this high and we started displacing past this low with speed. So now I'm thinking, oh, we could be in a sell program. We then retrace into this bearish PD array, this bearish fair value gap, and start cutting through this bullish PD array. So that makes me to believe that we're no longer in a bullish, we're no longer in a buy program. We're now in a sell program. So now I'm targeting the nearest significant sell side liquidity lows for us to take out, even if we were to go bullish. So if we were to go bullish and start, going back into a buy program, we'd have to take out this low. What do? We took out this low. We start delivering from it, but then we start accumulating, and smart money starts to accumulate and generate liquidity for us to take out. And this is easy draws on liquidity. Equal lows, right? What equal lows are lows that aren't exactly, right? These aren't equal lows because these lows have already taken out these lows. But these lows have been engineered. It's consolidation. These lows are failing to take out all of these lows. These are equal lows. Meaning smart money is creating these lows and generating this liquidity to later be taken out. And what do? We retrace, go back into this bearish PD array or this inverse bullish fair value gap, and we take out this high. We sweep this high and then cut through and displace past all of these lows with speed. Right? Boom. We then go to these lows. And so now the new day opens. The new day opens here. So now I'm thinking my bias is still bearish from now on. But I got to ask myself, where is price delivering from? Well, even though we're in a sell program, we're clearly in a sell program, we are still we're respecting and we're reacting off these lows. But how do we know that this reaction and this, mini reaction up here is not a retracement? Well, we have to see how smart money displaces past the highs to see if it's going to be a retracement or a reversal. Let me explain that in more depth. We got to drop down to the lower time frames and we got to see. Okay, so we're displacing and we're rejecting from this low, and we're clearly, on the lower time frame, on the 15-minute, we're disrespecting bearish PD arrays, respecting bullish PD arrays. We're going to react off this fair value gap, right? But this could, for all we know, this could be a retracement. How do we know it's not going to be a retracement? Well, we got to see how well it displaces past significant areas of buy side, right? If it was just a retracement, what we would do is we would come to significant areas of buy side like this high, and we would react off of it and start, displacing lower again. We'd start to go lower. But if it was a reversal, we would start displacing past and closing above these highs, we're acting as a higher time frame change in state of delivery or market structure shift that shows us we're now in a buy program. It shows us that smart money now wants to sell at higher prices, and we could target this buy side liquidity, this buy side, this buy side. So I wait until AM session hits. And what do? We displace past these highs with speed. That shows that we're in a clear buy program now. So we reacted off this low, and we've had a market structure shift above this high. That shows that we're in a buy program on the higher time frame, right? And it's a 2022 model, because what have we formed? We formed this higher time frame fair value gap. And what do? We take out this high. We start displacing past this high. That means we can now target this high, right? Boom, and this high, and we just fucking rally, right? But that's what you need to understand. It's like, okay, if we were to be bearish, let's say this happens, right, on the 15-minute. We take out this low, we start displacing higher, disrespecting bearish PD arrays, inversing bearish fair value gaps, respecting bullish fair value gaps, rejecting lows, breaking through the highs. Now I'm in a buy program, but I still assume on the 1 hour it's a sell program. But if it's not a sell program, then that means, and if it's a reversal, that means we'll displace past this high with speed. And so what you can end up doing is you can take risk reversal trades where you're like, okay, well, I'm not too sure about bias because on the 15-minute we're bullish, but on the 1 hour we're bearish. But I'm like, okay, well, where do we have to take out even if we were to be bearish, right? Or if If we were to bullet, for example, if we were to be bullish, we have to take out this high, obviously. And if we were to be bearish, we still most likely have to take out this significant buy side in order to go bearish, right? What high has to be taken out to fund the liquidity down, right? Because if your bias is bearish, then you should be looking for highs to take trades off. You should be looking for highs to be turtle souped for you to take shorts. So what is some significant buy side that has to be taken out to fuel the expansion lower? So I'm like, okay, my bias is bullish, and even if my bias was to be bearish, my draws on liquidity are still this high, right? That's why draws on liquidity are more important than bias, because they're areas of liquidity that you know you can target regardless of bias. For example, my bias on the 1 hour for taking trades here was clearly bearish, right? However, my draws on liquidity were this high to be taken out before going bearish, right? Because before every bearish expansion, we need to take out some significant buy side or sell side to do so. So I think you can understand where that comes from. Now, I just wanted to go through some easy levels to target. These levels are created almost every single day, and they are relative equal highs or relative equal lows. I touched upon them literally just now, but I'm going to cut this into the video. But relative equal highs and relative equal lows on the lower time frame, on the higher time frame, whether it be the 15-minute, 1 hour, or even the 1 minute, they're amazing for draws on liquidity because they imply engineered liquidity, that smart money is engineered for it to later take out. For example, what do we see? In fact, let me go on the 5 minute. It's better to see on the 5 minute. What do we see on the 5 minute? We are consolidating, which is price engineering liquidity for us to take them out. But what do we create in this consolidation? We create swing lows that happen to be relatively equal. What does that mean? Well, we know before every expansion, there's some form of turtle soup to happen. But this move happened without any turtle soup. We just kind of went up, right? So we probably want to go back to this area. And what do we leave behind? None of these lows, these lows still have resting liquidity. Resting liquidity, 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 liquidity. Smart money is engineering lows that haven't been taken out on purpose for them to be taken out later. And it's in the form of equal lows, which are the easiest form of low resistance liquidity. So once all these equal lows, even on the 5 minute, for example, equal low, equal low, equal low, equal low, equal low, and even on the 1 hour, equal low, equal low. Once we see equal lows, we're like, okay, we know we're in a buy program. We've retraced, taken out this major buy side at a bearish PD array that we know we're respecting. At a key time, which is 9:30 or market open, with this clear low resistance liquidity that we can target in form of relative equal lows, and we can easily target a short after some form of reaction, right? So relative equal lows and relative equal highs, some form of low resistance liquidity run, engineered liquidity is amazing to target,